Good evening, ladies and gentlemen. I'm Leslie McCormick, Senior Wealth Advisor with the Farwell Group, and on behalf of our entire team, I'd like to welcome you to our annual Outlook event. Our agenda for the event tonight will start with Darren Farwell presenting our team's outlook for the coming year. Following that, as is our tradition, our evening will then feature guest speakers who are experts in their field. This year, our guest speakers, John Moore and Brett House, will participate in a panel discussion relating to investments and the economy, and no doubt touching on some headlines of this past year and current investment themes. I don't know, you might have heard of something called Bitcoin. I'm sure that topic will come up. John Moore is host of Canada's #1 talk radio morning show, News Talk 1010. He's a TV commentator and newspaper columnist who can boast about appearing on Jeopardy! And these are his words, playing in a string of terrible movies and a couple of really good ones. Brett House is Vice President and Deputy Chief Economist for Scotiabank, providing macroeconomic insights and forecasts both for the bank and for clients, domestically and internationally. He's a Rhodes Scholar, has worked with both the International Monetary Fund and the UN Secretary General, as well as for Goldman Sachs in London and for a hedge fund company in New York. No doubt our guest speakers will provide us with some interesting insights into the hot investment topics of today. At the end of our panel discussion, we will open the floor to questions. But before we start our outlook for the year, I did want to introduce the members of our team who are here this evening. So first of all, our administration team, Rhonda. Everyone's standing at the back, by the way. Rhonda, Lisa, Sharon, and Jessica. A special thank you to Jessica for all of her efforts in planning and organizing this evening. As always, her events go off very well, and she does it well. So thank you, Jessica. And our advisory team, we have Andrew McCall, Eddie Lung, Patrick Ross, Mike Hastings, and Tim Ash. And to present our Outlook 2018, and then to moderate our panel discussion with John and Brett, I'd like to introduce Darren Farwell. Darren started with Scotia McLeod in Scotia McLeod's predecessor, McLeod Young Weir, in 1986. And set out to build what is today the Farwell Group, a team dedicated to helping our clients be able to do those things that bring them joy, to help them achieve those things that matter most to them through providing financial planning, investment, banking, and tax-efficient strategies to make their plans happen. So please join me in welcoming Darren Farwell.
Thank you, Leslie, and great to see everyone here tonight. And it seems like we got an absolutely perfect number of chairs. I don't know if that's ever happened before, so that's nice to see. And a special treat, Jeopardy, John? I don't think I've ever known anybody who was actually on Jeopardy. It didn't go well. You didn't beat the computer, that Big Blue or whatever it was. So thank you again, Leslie, and thanks for everyone on the team for your helping make this happen. I mean, shopping is changing. Investments are changing, technology is changing, communications are changing, so we thought, what the heck, this year we're going to change Outlook a little bit. And our change this year is really having two panelists who know a lot about what they're talking about to give some views that, hey, they might be even a little bit different than mine. They might be the same, but it'll be I'm really excited about the prospect of having two such distinguished guests coming up and me having the opportunity to moderate that for them. So, what do we have in store for us this year? First of all, a quick look back at 2017. Then we'll compare, for those of you who've been here year after year, we will compare our forecasts for what actually happened. We'll have a discussion about where I feel we are today. Well, it's not as much of where I feel we are, where we actually are today in the investment cycle, which is the virtuous cycle, a bit of a teaser there for where we actually are. Then I'll stick my neck on the line again and we'll give an outlook for 2018. And after that, this fun part that I was promising is we will bring on the panelists and get their opinions about some of the things that matter in the investment worlds these days. So there's kind of an old wise saying that a way to get good guidance about what might happen or what's coming in the future is to have a quick look back about where we came from. So I'm going to start the presentation today with a look at what happened in some of the major capital markets indices in 2017. Canada, 9.1% rate of return. That's the TSX 300. The TSX Total Return Index. Randy last year had pointed out, and I've noted in the presentation, that while we were referring to that index last year, the Total Return Index, we actually had the S&P 60. So it's the TSX Total Return Index, 9.1%. Very interesting to note, though, that if you'd looked at that number at the end of August, 0% rate of return for the year. If you'd looked at the S&P TSX 60, end of August, 0. The bank index, the end of August, was up 0.5. So the TSX made up a lot of ground, but all of it really since the end of August. S&P 500, well, that's 9 years now into a bull market. It's getting to be a long one. Big question about how much longer it'll keep going, and we're going to talk about that before we're done today, but that's 9 years of bull market, pretty impressive. International. Well, for those of you who have been here over the years and heard me talk, we've been talking about this concept called synchronized global growth. That is where really all the economies in the world, including Europe, Asia, the Far East, Japan, emerging markets, United States, Canada, all economies around the world are having positive growth at the same time. We're really at that spot now. Albeit some of those economies, the growth isn't very strong, but it's positive. So for the last couple of years, we've been waiting for this point of synchronized global growth. We seem to be there, and as you can see last year, there's a strong indication that in fact that's what's going on, because we're seeing a catch-up now in Europe, Asia, the Far East. It's been a long time since we've seen positive growth numbers out of Japan, but we're seeing that as well. The Canadian dollar, well, that was a big surprise. I don't think many people would have suspected the Canadian dollar did that well last year. We'll talk about that a bit when we come to our forecast section. Interest rates in the United States, and sorry, by the way, I've indicated Canadian interest rates by showing the prime rate. I mean, that's not the bank rate and that's not the bond rate, but it's an indication of where rates are going in Canada. And for those of you who have a line of credit, that prime rate is probably quite important because your rate is going up as the prime rate rises. In the United States, we were surprised a little bit by how the Canadian interest rates went up a little more than expected. There's a bit of a surprise in that the US rates didn't go up very much. What we saw in the United States is that wage inflation remained quite subdued, that price inflation, housing inflation remained quite subdued. So at the end of the day, we didn't see a significant change in interest rates in the United States. Stayed in that area of 2.41%, and gold at 1,309 was up on the year. Okay, so 2017, as the song goes, I think it was a Frank Sinatra made the classic, was it? It was a very good year. Well, I would say it was a very good year. It also, I think, highlights the importance of one of the investment principles that's foundational for the way we invest money as a team. This is a proof of why in a portfolio, as a Canadian investor, you really want to have global diversification. There's the odd year where Canada is the best stock market in the world. Well, I can't remember the exact years it was in that period, 2005 to 2010, where the Canadian market really was the best. So you could have had all your money there in those particular years. But by and large, you want global diversification. Well, that was 2017. A good year, but now here's the part where usually, as I say, I get my head handed to me. Because the fun part is that I'm going to show what our forecasts were for 2017. Now, big disclaimer on this. We do not, any of us on our team, pretend that we know where capital markets are going in the next year. So it's not about that. I mean, everyone has heard and I'm sure experienced the fact that over 1 year time periods, we really have very little idea what will happen over the short term. Over the long term, as a prudent, disciplined investor, we have very high ability to forecast how things will go. In the short term, not so much at all. However, as active managers, we do adjust portfolios relative to our outlook. So it's more directional than being precise. If we believe that more money will be made in the United States than in Canada, then we'll shift more money into the United States. If we think more money will be made internationally, then the United States will outweigh international. If we think interest rates are going up, so bonds won't do well, we'll reduce the amount that we're exposed to bonds. So this is an exercise more in what we see happening directionally over the next year, but we do put specific numbers out there for you to look at. So drum roll, please. How many people were here last year? Rats. All right. Okay, here's how things went relative to our forecasts. So Canada, as I said, we thought things would go a little better in Canada, and we thought they would go better in Canada because we really felt commodity prices would rise earlier than they actually did. So from September on, we started to see the impact of commodities rising. We started to see the impact of interest rates around the world rising, and therefore an indication that there's demand. But it came a little late to get a good full year in, because as I said, as of August, that was at 0. But not a bad year for Canada. United States, wow. Again, not many people were thinking we were going to get that kind of return. By the way, at the start of the year, we certainly didn't see anything. We didn't see a recession happening in the United States. And after all, that's what we're watching for very carefully, recession. But we did think that with President Trump, that maybe returns would be a little more muted than they were. But there's a big lesson in that. And that is, the facts are that politics generally only represent about 10%. Responsible attributes only 10% of what happens in the economy. There's a strong indication of that. With President Trump, we still had a fabulous year. But even more importantly, what's more important than politics is taxes. Significant reduction in taxes, investors like that. Business people like that. And President Trump did manage to get a tax package through. And you can see, with no recession in sight, less regulation, less taxes, looks pretty good. Internationally, so we've already talked about what happened internationally. Oh, and sorry, I forgot to say, Jessica or somebody, if you could just remind me when I'm at about 20 minutes, maybe someone stand way up here because I want lots of time for our panelists. And I could talk about this stuff forever. Internationally, synchronized global growth. So outside of North America, we finally have this spot where all of those economies are doing better. The Canadian dollar, well, did better than we expected, certainly the top end of the range, but we thought the Canadian dollar would go higher relative to where it was because of commodity prices. Interest rates, as you can see, we thought interest rates would go higher in the United States last year, but they didn't. They're starting to go higher now, but they didn't last year. Interest rates in Canada, sorry, we thought they wouldn't go higher, and then they did go higher. Now, we had some very strong GDP numbers, very strong employment numbers out of Canada, the Canadian economy, in the spring. And it wasn't long after that we saw the Bank of Canada raising interest rates. So Canadian dollars has gone higher. And gold, I want to give a shout out here to Tim Ash, who's standing at the back there. Tim is our gold bug. And as you can see, he did not a bad job of forecasting where gold was going to go. He thinks he's going to bring that up during performance review, but there are a lot of other things that are involved in making those judgments. Now, I did also, to make us look a little better, you notice that I put on the US and international returns. The numbers on the right are the Canadian dollar adjusted returns. So as a Canadian investor, if you took those foreign returns and translated them back to Canadian dollars, that's what the return would be. Now, some people who have US investments don't convert them back, so your return is the one on the left. But if you did convert them back, that's what it would look like. Secondly, there are many ways of investing internationally where they hedge the currency exposure, so your returns would be a little less than that because you have to pay for hedging. That's why I put those numbers, just to give you some context as a Canadian investor, what that would look like. Okay, so actual versus forecast in 2017. Again, very good year. We'll see in a minute why that's the case. So that's where we were. Let's take a look at where we are today. Well, I'll sum it up before we get started. We're still in a very happy place. Here's why. So this is the investment cycle. In the investment cycle, this isn't sort of my interpretation of the investment cycle. This is the investment cycle, right? And the investment cycle is really, when you look through history, we go from one recession to another recession. That's a pattern that repeats itself over and over. Of course, what we don't know, there's a lot of things about that we don't know. How long will it be from one recession to another? What will cause the recession? How high the market will go? Although inevitably the market goes through its previous highs, and so we get to record highs. So the last recession ended in the United States in March of 2009. And what you see in phase 1, 2, 3, and 4 is really a transition from an economy that the central banks and governments need to support to get things going again, to the point where the economy is running really well on its own, particularly, again, United States. This is really an investment cycle in the United States because Canada tends to be a bit more of a commodity bank economy and not a well-diversified economy. Right? So after the bank in the United States and the Federal Reserve in the United States first raised interest rates in December of 2015, we entered phase 4. Now there are some experts who say that actually started in June of 2015. I won't get into the details of it. That's a very good argument, by the way, but I don't think it really matters. June, December, in 2015, we actually made the change from an economy that was being supported and driven by policies, low interest rate policies, et cetera, to one where they were saying we're going to let the economy go on its own and raise rates. The market then always goes down because there's a question about whether that will cause recession. The next stage is phase 5, and phase 5 is called the virtuous cycle. And it's called the virtuous cycle because it's such a happy time. It's the only time in the entire investment cycle where global growth is rising, interest rates are rising, and remember, interest rates rising initially is good because it means there's demand around the world, and stock markets are rising all at once. So this isn't my suggestion that we're here, we are here. What we don't know is when here ends. The consensus is 2019. I'm suggesting there's a lot of argument that could be made for it's much longer. Right? So what's the argument that it could be much longer? Here's a historic look at the markets. The blue lines are bull markets. And they're called bull markets because the bull, gores you from below and throws you up in the air. That's a bull market. And the red lines are bear markets. And they're called bear markets because the bear pounces on you from above and knocks you down. I always thought there'd be a more sophisticated explanation for those things, but that's what we've got. So you'll notice the expansion that we're in right now, the bull market that we're in right now, is the longest ever since the 1920s. But these markets, bull markets, don't end because they're going on for too long. They end for a reason. Okay? But back a second, after phase 6, we know what's coming. Sorry, after phase 5, we know what's coming. 6, 7, and 8, that's the next recession. That's what's coming. When will it be? Don't know. But look at that line and see in the 90s, it went substantially higher than where we are today. So there doesn't seem to be a recession in sight. We can't see the factors that would cause a recession in the United States right now. And it's not like we've never been here in terms of rates of return for the market. So the consensus is still that we may head into a recession in 2019. We don't know if it could be mild recession. It could be a very short recession. Don't even know exactly what would cause it. That's a possibility. And what we need to think about a little bit is if it's 2019, then the market's looking forward, hey, that could start to impact us in 2018 at the end of the year. So what are we doing? In terms of active ideas, in fixed income, we're buying preferred shares because with rate reset preferred shares, because as interest rates rise, rate reset preferred shares pay a higher rate and therefore their prices go up. Also, secondly, if we're in synchronized global economy where growth is happening around the world, we would expect demand to rise. If demand rises, the cost of commodities should rise. Therefore, we want to own investments that have exposure to commodities. So the three things that are my conclusion from that look at where we are today. Number one, if you have significant cash needs or income needs over the next 2, 3 years, 1, 2, 3 years, start getting it into cash now, particularly by the end of April, because the market could change at any time. We know the next stage is stage 6, 7, and 8. Just don't know when. So significant cash needs, start getting it into cash. Number two, for that long-term money that you have, the money that you don't need in the short term, the money that's going to be invested for the long term, keep it invested. Because as a matter of fact, when you saw that bull-bear chart, we could still have 2 fabulous years. So you don't want to have too much cash sitting on the sidelines when those kind of returns are potentially there. And number three, as this phase continues, as phase 5, the virtuous cycle continues, if I'm standing here next year and that circle is further ahead, we're going to start, in fact, we're looking at it right now, looking for investments that will do well if the market does well, but are also going to not get the full impact of a declining market. So those are called non-correlated assets. We are actually searching for non-correlated assets that we can start adding to the portfolio to dampen the decline when the time comes. Also, they suspect there's going to be a lot more volatility. Right? We really haven't had too many 8 or 10% down moves. We probably will have some more of that. 2018, what do we see happening in 2018? Well, we'd like to see Canada benefit from higher commodity prices, but NAFTA, don't know. So it's a bit of a hedged bet in Canada. We'll do well if we don't get too disrupted by NAFTA and the global economy continues to improve. So good returns in Canada. United States, 8 to 10. For heaven's sake, I looked at my sheet today, they're up 6. We're not even done January yet, so we don't have far to go to get to 8 to 10. But the reason why we're going to stick with 8 to 10 is, remember I said I do expect we'll get more volatility this year. So that 6 could pretty quickly go to a -2 sometime in the summer and then build up again by the end of the year. Internationally, that's where we see a big win. So we'll be increasing weighting in our portfolios to international. There's a lot of catch-up to make there. We think there'll be a very good year again internationally. Canadian dollar, asterisks, totally depends, we think, on NAFTA. And I know we're going to touch on that later. Interest rates in the United States, we believe we're already seeing it. This is the year that they've started going up, but we don't expect they'll go to 3. 3 is kind of a real magical level. If interest rates go over 3, then U.S. investors start worrying about inflation. And if U.S. investors start worrying about inflation, that could cause the stock market to go down because rates would then go even higher. Interest rates in Canada, maybe a bit higher, and gold definitely higher, and we'll see whether Tim can make another win based on his gold prediction for next year. So that's our forecast for 2018. I certainly can't finish any presentation with talking about our mothership, right, Brett? Bank of Nova Scotia. Each year I bring up Bank of Nova Scotia. So the dividend over the last 10 years up 75.29%. If you just divide by 10, that's 7.2% average. But if you use a compound rate of return, it's about 5.77. The total return, 7.65 versus the market return of 4.6. So good quality investment, good investment to put in your pocket and reap the dividend over the years. Okay, I can't imagine I could talk much more quickly than that. But I wanted to talk quickly and get through that forecast quickly because it's going to be really interesting having our 2 panelists up. So we have John Moore. Thanks for coming, John.
My pleasure.
Go on up and
Where do
have
you
a
want me
seat
to
over
go?
there. Have one of those 2 seats. John is the host of Moore in the Mornings on News Talk 1010 Radio, and he's one of those 2. He's going to give us a real sense of what the pulse of the people is, as well as his own personal opinions. And Brett House. Thanks for coming, Brett.
Thank you.
Oops. What happened? Did I turn that off? I probably turned that off, did I? Brett is the Vice President and Deputy Chief Economist at Bank of Nova Scotia. So I'm looking forward to what they have to say about what's going on in the markets. So we're going to do it for about 20 minutes, and then we'll talk for about 20 minutes, and then we're going to open it up for questions. So hello, John.
Hey.
Brett.
Hi.
So far I've been talking about, our team's outlook for 2018. Pretty rosy picture based on synchronized global growth and interest rates staying low and inflation staying low. I've had my chance to speak. I'd like to start off the discussion with John, you and Brett both having, give me your personal outlook about what you see happening in or outlook for 2018. Now, John, I'll start with you. Your work on the radio show, and you do a lot of work with the public. Why don't you give us, a bit of you've got the pulse of the people, as they might say. Why don't you give us some insight into your personal view about what's going on, and what are people thinking out there? What are they thinking? What are they worried about in 2018?
Well, I think it's important to note, actually, that economics is treated often as a science, and of course, to a degree, it is a science, and maybe you and I are going to get into a wrestling match here.
Awesome.
But it's also about collective psychology, and collective psychology can turn into a run on tulip bulbs, obviously. So,
Or Bitcoin.
Or Bitcoin. You can talk about Bitcoin. I had another go at trying to understand Bitcoin the other night, and it did not go well, much like my appearance on Jeopardy! For the record, my money is also looked after at Scotiabank, and so I had my sit down with my financial manager, and much like you, he sees a fairly rosy, year ahead. And for me, my job has always been in talk radio, and maybe some of you saw me on the National, where there would be 3 pundits, and they'd talk about these very pointy-headed aspects of government and society, and I would say, okay, but here's what people say to me when they call my show. Here's what they say on my show. And that's a much more gut-driven, street-level approach to things. But what I can tell you is that I think the economy is in a fairly sweet spot. And what I like is, my belief is that it's not a self-driving car, but we have more levers right now in order to look after bumps in the road that lie ahead. For example, we have a lot of room to maneuver in interest rates in Canada. So I'm enthusiastic. I'm not unreasonably, what do they call it, irrational enthusiasm. I'm not getting into Bitcoin. But I think things look very, very good, and I'm kind of excited about the year ahead, and I hope that this bull market goes longer than 2 years, and it just, somebody would have to do something to screw up, because if you look at the major downturns, they've been because of medium-term stupid collective decisions in the 90s, and then again in the beginning of the aughts, as I guess we're going to call them now.
Okay, thanks, John. So, Brett, as Deputy Chief Economist at Bank of Nova Scotia, you obviously have a wealth of data, at your fingertips.
Yeah, I'm the pointy-headed guy on the stage today, as John put it.
So with this wealth of data and your own personal opinion, what do you see? What's the outlook for 2018 from your bird's eye view, the macro view?
Yeah, well, I mean, we're broadly aligned in the take both that you're picking up and also that you recounted earlier. I've given a number of talks in these first few weeks of 2018 about what the year ahead holds. And it's a slightly strange position for an economist to be in, because we're normally, the dismal scientists or quasi-scientists in the room, the guys who are saying, calm down, like it's not all that great. But I'm in the strange situation of usually talking with groups where I'm a bit of the cheerleader saying, actually things are better than maybe you think they are. And most of the data points in that direction. In terms of the synchronicity or the coordination of growth globally, I mean, our team is only large enough to cover about 30 economies in the world. But if you look at The Economist magazine, their intelligence unit, which covers all 190 economies in the world roughly, they're anticipating that only 4 countries are going to contract in 2018. Wow. And if you look at which 4, it's maybe no surprise. North Korea, Venezuela, Equatorial Guinea, which you may not be familiar with. I had the somewhat dubious pleasure of traveling there back in 2004 when I was working at the International Monetary Fund. It's a speck of a country south of Nigeria that produces an enormous amount of oil with a very small number of people there. The reason why it is anticipated to contract is because most of the oil unfortunately gets stolen by a very kleptocratic government. And then the 4th place that's set to contract is Puerto Rico, which is a territory rather than a country. But when you think about 190 countries in the world and only 4 countries, 3 of which are running disastrous policy regimes, and one that just got wiped out by a hurricane, that really speaks to a very rare situation where the whole world is in a sweet spot. It's growing. It's not growing at the blow the lights out kind of rates that we saw in the 90s by comparison. It's kind of, almost very Canadian, sort of nicely frothy, but not too exciting. So I think the world, not just because, Justin Trudeau is the most popular prime minister in the world, and the set in Davos have judged Canada as having the most trustworthy and sort of brand and respectful brand of any country in the world. It's a kind of excited but not too excited world out there where things are growing in a synchronized way.
Well, what's interesting about that, I'll come to John, is when you looked at the virtuous cycle there, phase 1, phase 2, phase 3, all of those phases were different than historically in the fact that they all were so extended, much, much longer than historically they were on average. So it wouldn't be a big shock that also this phase 5 part of the cycle we're in was longer. So, that may be consistent with the fact that this cycle could go on longer than you think. But one thing I always watch carefully is when you start reading a newspaper and the newspaper says that this cycle is going to go on a lot longer than you think, that's when we start getting a little bit nervous.
Yeah, it's when your Uber driver is giving you financial advice.
Yes, yeah.
It's always a bad sign. I have one concern. It's more societal, but I also think eventually we're going to see this impacting more on the aggregate economy, and that is that young people, we've raised a generation of people now who don't know that money costs anything and who don't appreciate that that going into debt is not a great thing. And I think psychologically that's created a generation of people who do not have an incentive to share, no, they have a great incentive to share, to save, and who may be very deeply in debt. So that's a risk, and if they continue with that behavior, and that dovetails with, we now know that some retirees are still retiring with mortgages, that often concerns me about just how over-leveraged some people may be, and that psychologically they're not behaving as economic actors the way we might.
particularly in an environment where interest rates seem to be rising. Would you say that's happening kind of around the world? We're seeing rates starting to rise?
Well, only just starting. I mean, Canada and the United States are at the leading edge of that because we have economies that are growing beyond what we estimate their underlying potential or underlying trend is, that actually allows an economy to grow without setting off price pressures because there's too much demand chasing too low supply of goods and services. Canada and the United States have pretty tight labor markets. We have pretty tight goods markets right now. And so, on the one hand, you might normally think central banks raising rates, and the Bank of Canada and the Fed are the only two really doing that right now outside of a few emerging markets. You might think that, well, that's heralding the end of the party because the job of central bank governors is always described as being the guy who arrives and takes away the punch bowl right as the party gets going. In this case, it's more like in a very long expansion such as the one we've had, it's more like closing down the bar at 2 a.m. before things get really sloppy at this point. This is a situation where rising rates is actually a pretty good thing for extending the expansion in the cycle, because typically in really elongated expansions like the one we're in now, and it will actually move from being the third longest in North American history to the second longest if it keeps going in May, and we entirely expect that to be the case. But typically, these long cycles get brought to an end not because central banks raise rates too early, but because they do so too late. And when they do so too late, they have to raise rates quickly and substantially. And that ends up tipping the economy into recession. So instead, what we're seeing this time around, because the Fed and the Bank of Canada are really clear, since the financial crisis in 2008, we don't have as good a handle on how the economy works as we did before. A lot of things got changed, a lot of things got destroyed. So they're moving in a gradual way. A hike in July, a hike in September, one just now in January. That's totally different from the past. Normally they go meeting after meeting until they hit the interest rate that they think they need to keep inflation under control. In this case, it's move, have a look, move, have a look, move, have a look, gingerly, to make sure we don't tip the apple cart, but we also prevent the apple cart from moving so quickly it runs down the hill and spills everything at the bottom.
Thanks. That's some great insights there, Brett. Thank you. I wrote a couple of notes down to talk to clients with. Let's talk about something that's been on, I think, the collective minds of and consciousness of Torontonians and those living in the GTA for what seems like forever, and that's the cost of housing, and probably most importantly, when's the bubble going to burst? Now, I know, John, that you produced an investigative series called Real Estate Reality, and that focused on the implications of this hyper housing market in Toronto. And if I remember correctly, you even yourself went and have bought a second property. So could you put those things together for us and share your thoughts on Toronto real estate?
Sure, it's crazy. And I love real estate. I call real estate the new porn. My partner will walk in to my office late at night and say, "What are you doing? What are you looking at on the computer?" And I'm surfing MLS. I love it. Clicking through pictures, looking, what did it sell for the last time? In our investigative series, the focus was sort of the implications in terms of lifestyle and some of the crazy things that are happening these days and some of the amazing things that are happening. People in Toronto, for example, are selling the homes they've owned for 30 years. So say you sell that in Toronto and you bought it for, 30 years ago for $32,000 and you sell it now for $1.2 million. And a lot of people are now moving to Whitby, Niagara, St. Catharines in particular. St. Catharines, with all due respect if anybody's from there, but it was, it was a little sketchy for a while, and it is totally on the rebound now.
The only thing I quibble with is for a while.
I know, I said it to Tim Hudak, and he objected because he had to. But to get back to these numbers, I mean, it's incredible the equity you can end up with, because you'd have $1.2 million from the sale of your Toronto home. You'd go to Niagara, get a bigger one, and you'd paid like $550,000 for it, and the rest of that goes into the retirement account. Other pressures, of course, are that people can't afford to get into this market. A friend of mine moved from Montreal, and his wife was still in Montreal with the kids, and he was looking at houses, and he would go and see a house on a Thursday, and he'd phone his wife and say, "It's perfect, come and see it on Saturday," and it was sold on Friday. And as a matter of fact, auctioned off on Friday. That craziness is behind us, but I've been very, very lucky. I've bought 2 properties. I'm a big believer. I frankly think real estate, when you rent it out, is a racket because you get the government's paying your interest. You get to deduct your interest because you're running it as a business. The first time when I bought a house in about 2009 in Toronto, we were absolutely convinced in the month of May that we had overpaid for it. And so I kicked myself and kicked myself. I thought I probably lost about 20% of the value I had overpaid. And then a year later, we were already 5% over what we paid. But more exciting than that is when I finally decided to buy an investment property, it was, again, in the month of May last year. And as you'll remember, that is about 6 weeks after they brought in all the new rules, and the market was completely moving beneath our feet. And my story was that I thought they had put a very fair price on it. So I waited, and I waited because I knew the market was shifting, and I knew they weren't going to be able to auction it off. And the real estate agent called me on a Tuesday and said, we thought there was going to be a bidding war, and there isn't. And I said, well, that's fine, and I hung up. And then he called back 2 days later and said, would you be prepared to make an offer? And I said, yes, I would. And so he went to the owners, and then they came back and they said, we'd like $50,000 more than we listed it for. So I sent an email to the real estate agent that said, go tell them to F off. And I didn't just put the F. Because you probably know real estate's a very personal thing, whether buying or selling. When I was selling my parents' house, I was very personally insulted to get a low-ball offer. There's something visceral and emotional about real estate if you have a personal connection, if it's your future home or the home you're leaving. But anyway, I was so ticked off, I said, walk away. And they called back the next day and went for asking. So, that doesn't necessarily inform anybody's investment decisions, but that was that's my party piece about how I got into real estate again last year.
Well, and John, you raise an interesting point. Because the prices are getting so high, it is difficult for the younger, our kids, for example, maybe to buy a house. How many people here have been involved with helping their children get their first home because otherwise they can't possibly do it themselves?
Okay, how many of them have their kids living with them?
Yeah, that's the other half. That's the other half of the crowd, yeah. Okay, well, thanks, John. And so, Brett, from the view, as the economist focused on, forward-looking macro data, what are your thoughts about what's going on in Toronto real estate?
Well, I'll start with the personal. My parents are just hitting their 80s and about to sell near St. Catharines, so I'd encourage all of you to decamp from Toronto for Niagara. It's lovely. Wine country is a terrific place to spend some time. But more broadly, in terms of the big numbers, they suggest that even with the craziness of the market and valuations being stretched by any traditional measure, they should hold together pretty strongly. And I'm actually speaking against my personal interests here now. Aside from wanting my mom and dad to do really well on selling their house, I moved back to Toronto from the States only a couple years ago. I'm still renting. So I would like nothing more than the Toronto real estate market to fall apart. Yeah. And unfortunately, I think that's very unlikely to be the case. You've got the highest immigration rates we've had into Canada since before World War I. You've got strong interprovincial migration from the rest of Canada into the lower mainland of BC and southern Ontario. You've also got rural communities basically emptying out and moving into the 10, 15 biggest cities in Canada. If you're a small town and you don't have a resort or a university or some other kind of pull, you're basically dying. You've become a retirement community, even very close to Toronto. So, when I say I'm kind of from St. Catharines, I'm more from St. Catharines adjacent. I grew up in Vineland, a little village to the west of St. Catharines. All the little villages around there have basically emptied out of kids and families. John profiled a couple years ago my fight to save the little one-room schoolhouse I went to kindergarten in because all 5 schools in the surrounding villages were being closed down because there were just no kids. So, what's happening? Well, people with families who want opportunities are moving into big cities like Toronto. Add into this, and this is where I get seriously pointy at it, I justify wearing the nerd glasses tonight. In our international transactions with the rest of the world, Canada runs a persistent trade deficit. We buy more goods from abroad than we actually produce here and send abroad. In order to finance that, and this is seriously into nerddom, But so long as you run a trade deficit, you have to have a surplus in capital flows coming into the country. And if capital is flowing into Canada, it has the choice of 2 or 3% on a government bond, or taking a chance on real estate in a place like Toronto or Vancouver, with all those other factors of people flooding into these cities I mentioned. I think it's going to keep going into real estate in places like Toronto and the Metro Vancouver area. So overall, you know, it doesn't look good for me getting in at a sweet price. In this
You have to
market.
account for some aberrant behavior in the market, though. For example, I know some people will go into a condo tower project when it's before construction, and they'll buy units the way some people buy stock. And there are, we can't enumerate, there's no way of keeping track, but there are people who own, you know, they'll move in and buy 10 units in a condo, they leave it empty. They pay a guy to go once a month and check it out. I mean, that is how bizarre the market is when they could be renting that condo out for 1,200, 1,500, 22, whatever, how many rooms it may have. They leave it empty because the market has grown so significantly. Now, I think the crazy growth is over. Year to year, 2016, 2017, we had 30% growth on real estate, which was just madness. That's over.
Yeah.
Well, and to support your point, Brett, my mother's here. Hi, Mom. And
You look after your mom's money?
And, you know, she grew up in Smiths Falls, so I visit relatives in Smiths Falls. And for those of you who know, it's kind of on the highway between Kingston and Ottawa. And it's one of those towns that you're talking about where people, you know, really aren't staying and jobs are leaving. And I met my uncle in the summer, and I said, well, you know, how's your real estate doing? You must be up on your real estate. He said, Darren, I've had the house for about 15 years, and I'm down 20,000. I mean, it's so different when you get outside of the big cities. Thanks for your thoughts on those, guys. So one topic that Leslie alluded to earlier that I want to make sure we touch on, and that is weed stocks and Bitcoin. Because seriously, it's hard to look back at 2017 and not at least acknowledge the stratospheric returns that we got in weed stocks and Bitcoin. So I think we should talk about cannabis-related stocks. Now, I know the bank is very careful about us talking about cannabis-related stocks, Brett, so I'm going to ask you the first one, which is about Bitcoin. What's the big deal about Bitcoin and cyber currency? And secondly, is blockchain the bigger idea? Is that the really important one?
Yeah, so, you know, the head of JP Morgan, Jamie Dimon, for the last few years has been saying, you know, that Bitcoin is basically a means of payment for money launderers, organized crime, and terrorist financing. And the reason why is because it doesn't leave any trace. You know, the transactions are entirely anonymized. And I think the price of Bitcoin or any of the other cryptocurrencies at any given time is essentially an index of how much you want to evade taxes or move money in a way that the authorities can't track. There is no underlying rationale for valuing any of the cryptocurrencies. And so, you know, if you're going to get involved in them, use the same sort of pocket of funds or change that you use for your trip to Casino-Rama or Vegas and treat it in exactly the same fashion. It is not investing to get involved in cryptocurrencies. The accompanying idea of blockchain that gets discussed along with it is the sort of broad generic term for the underlying technology of a distributed ledger. So the idea being that, you know, when you swap a cryptocurrency unit between people, you don't have to actually go through something like a bank payment system like Interact. You can transact in a way that is verified and can be proven to not be counterfeit without any other authority getting involved, no one watching, no official channel being used. And so there's a lot of excitement about using this distributed ledger technology for payment systems like the ones banks engage in, for the transfers of real currencies like Canadian dollars or US dollars. But the thing that kind of gets missed in that discussion, and I'm really even talking about going against some of the bank's party line too. We've got a whole thing called the Digital Factory working on blockchain over on King East. You know, the original blockchain that works really efficiently right now is Interact. You know, it actually costs less to do a transaction on Interact than it does through cryptocurrencies like Bitcoin. But the difference is when you do an Interact transaction, you know, the banking system sees it and potentially regulators see it. And so, you know, for any of us who don't mind that, you know, don't worry, you're not missing something important. Like, keep doing your transactions on Interac and you're actually getting a better deal. If you're really concerned and have a need for doing some money laundering, then, you know, give cryptocurrencies a look. I mean, but don't say you heard it here.
You want to talk about that, John?
I know nothing about cryptocurrencies. I just know that two sets of people have made good money on it. One of them being 50 Cent, the rapper, who made a lackluster album 4 years ago and accepted payment in Bitcoin when a unit was worth $350 and now it's worth more than 1,000. Well, it depends. It's been 1,008. No, it's 10,000.
No, it's like 10,000.
10,000, yeah.
It was up to 20.
It was up to,
recently.
exactly.
Yeah.
But still, he's done well. And I don't know if people remember the Winklevoss twins, but they're the two guys from Harvard who claim they co-invented Facebook, and ultimately they lost their lawsuit, and they did not, they got a very minor share in Facebook, but they've turned to cryptocurrency and they're back in the coin.
How about that?
But the thing is, what's really tough is to actually realize any of those gains. So
Yeah, how do
there's
you cash out?
There's a terrific story of someone who tried to cash out 1 Bitcoin, and the cost of cashing out the Bitcoin actually ate up almost all of his returns.
Wow. Yeah.
So, like, you know, none of this is an evolved system yet. It is truly the wildest of West
Right.
in payment systems, and so.
So it's really early days, and
Super
and
early
enter the pond at your own risk.
Yeah, you know, I speak as a, you know, they talk about, you know, alpha and beta and omega adopters. They're the people who line up for a new iPhone every time one comes out. I'm the guy that gets the hand-me-down from my sister. You know, I am perfectly content for other people to work out all the tweaks and the problems here, and I'll come in when it's working pretty well. But then I also miss the real estate market in Toronto and every city I've lived in. So, you know, take my predictive power with that in mind.
Well, John. Now we got to move along because I do want to make sure we have for questions, and I'm going to ask whether we should have one or two with you guys after this. It's really so enlightening. But John, now, just because I'm asking this, there's no implication about your personal habits. I'm not
That's quite a
suggesting
preface.
it.
I will say on this front, I am as square as Brett is.
Well, I have heard you talking about how the corporatization of pot
Yes.
is really quite fascinating. So why don't you give us the weed question and what's your outlook for what's going to go on there?
Well, a lot of volatility, as you folks know, and I find this to be, I mean, aside from prohibition ending and booze going from illegal to legal, we've never been here before that I know of. And as a matter of fact, booze was legal before it was illegal. Pot has been illegal. It's been an illicit substance. People are doing jail time. People can't travel to the U.S. because they have criminal records. There are people now whose shops are raided by the police. And then sometime next summer, the big corporations will be selling you pot. I mean, the LCBO will be selling you pot. The Westons tried to get in on the market. They wanted to do it through their drugstores. I am fascinated by this whole process of how you go from something that is now illegal to the point where, if I understand you guys, you are technically not allowed to talk to your clients about pot as an investment, about cannabis as an investment, until such a time as it's legal?
Yeah, I don't know. I don't know about Brett, but we cannot recommend it. We can discuss it, but we cannot recommend it.
Much like Bitcoin, there are people out there making a fortune, and one of the principal reasons is because we have this sort of gray zone of medical marijuana. So those are legal companies. They are allowed to make the stuff, sell the stuff, turn a profit. They are, of course, completely poised like runners in starting blocks to run out of those blocks as soon as it's legal and get into the recreational market. There were, I think, 38 licenses in Canada for medical marijuana, and what's happening right now is those companies, of course, are buying each other out. Whoever thinks is going to be a small operator or the big operator. I sat down with some executives, and I'll tell you, it's mind-boggling that something that used to be some sketchy guy, you know, selling you stuff out of his motorcycle bin or whatever, that now it's major big corporations that they've recruited from other fields of endeavor. And I met with one guy from Canopy, which is regarded as one of the absolute future kingpins. I mean, already they're the first over $1 billion, I think. Yep. They're in the process of building a greenhouse at the Edmonton airport so that they'll be able to pick and fly, or whatever, they don't pick and fly, but, you know, cure and ready to ship. They have an app where you can have it delivered same day pot delivery. This is, you know, turning.
Better call Sal.
Yeah, it's the change in mindset and the leap into the business world is almost mind-boggling, I find. And one last quick thought for you, because I've spent a lot of time on the file because it bothers me, the business I said, that, you know, there are people with criminal records currently that affects their ability to be bonded or to travel and stuff like that. Mark Emery was deported to the United States because he was a pot activist and he was selling seeds for pot through the mail. He was deported by our government to the States to do prison time. Now that pot is being legalized, he and his wife are still being harassed, and by the legalization day, they'll be in no position to do business because they'll have been big-footed by the big corporations. So that's the strange thing here. Government and big business are moving in on something that was very artisanal and mom and pop.
My takeaway from that was on the pot file, John spent a lot of time on it.
Oh, yeah.
You heard that too, didn't you, Brad?
Yeah,
I did.
you know, like whether it's Bitcoin or pot though, I'm going to posit that there's a better way to spend your time if you're thinking about asset allocation.
But you can't smoke Bitcoins.
No, you cannot smoke Bitcoin. You can't really do much of anything with it. Like try going into a supermarket and spending Bitcoin. I think a lot more about the fact that if you own a house, then you already are massively exposed to Canada in your portfolio. So, you know, think in your asset allocation decision, what are you going to do to diversify from your Canadian exposure? And not because I think Canada is a bad bet, but because Canada is, you know, already heavily concentrated in your total range of assets. And that's where, you know, your discussion about what international stocks, either in emerging markets, Europe, Asia, are going to do, other asset classes that you might be able to get exposure to, you know, such as alternatives, private equity, trade finance. Think hard about how you diversify outside of Canada, and pot is not getting you diversification outside of Canada right now. That, you know, is going to be uncorrelated with what's happening with your house.
Thanks, Brad. Well, thanks for your discussion on those two things. Now, I would like to look, when President Trump was elected, I guess a year and some time ago, I remember shortly after that 10 out of 10 calls for the next several months were entirely about President Trump and what did this mean. And interestingly, many of those calls were in tears. There were people crying at the thought that President Trump had been elected and were quite worried about what would happen. And interestingly enough, now it's, you know, still 8 of 10 calls as what's going to happen as a result of President Trump. So we've got 2 questions, this question and one more quick one, then we're going to open it up to everybody. So what are your thoughts about President Trump these days and what might happen? Go ahead, you go first, Brett.
Well, I think, you know, on the file that's most important for Canada, which is NAFTA,
yes.
My main message is look through the headlines, look through the tweets, don't get caught up in the day-to-day volatility of what Trump happens to be hiccuping. You know, we can see just in the span of the last few weeks, he's gone from, you know, I'm probably going to terminate NAFTA. That's the best thing to do with it, to, you know, actually I feel pretty constructive about it. We've had a lot of progress in negotiations. The Mexican elections are coming up in July. There's a need for some flexibility to extend the negotiations beyond that. I understand why you can't, you know, do a deal in the midst of an election. Then right back to, you know, I think I need to terminate NAFTA. So, you know, if you reacted to every one of those comments, you would almost certainly be losing money. The political, economic, and financial incentives for the United States to stay in NAFTA are massive. And so, you know, for those reasons, we continue to say, you know, keep calm, stick with what your underlying decisions, whether it's in trade or your asset allocations would otherwise be, and also be somewhat assured, not just that we think NAFTA will come to some kind of negotiated conclusion that keeps it in place, but even if it doesn't, here's some perspective to keep in mind. It is true that 75% of Canada's exports go to the United States. That accounts for about 20% of our total output every year, or total income in Canada every year. But only about half of those exports actually take advantage of the NAFTA trade preferences. And that's because compared with 1994, when NAFTA came in, the tariffs that would be imposed on our goods without NAFTA are a whole lot lower than they were before. So the advantage NAFTA gives us has shrunk. It's shrunk so much that in some areas, those tariffs are so low that companies don't even bother taking advantage of NAFTA, because all the due diligence and the filings you have to do to get a zero tariff under NAFTA aren't worth it compared with 2 or 3% under the tariffs that are otherwise charged. So, there are a lot of ways in which we are overly catastrophizing the impact of an end of NAFTA, and the U.S. is overplaying its leverage in this deal. NAFTA can vaporize, and it will not be the end of the world. Will the Canadian dollar tank almost immediately? For sure.
Yeah.
Is that an opportunity to buy the Canadian dollar? Absolutely, because within a year or two at most, the ship will be righted and things will be carrying on more or less as they were.
Well, one of the things I'm going to take away from tonight, Brett, is over-catastrophizing. I love
don't do that.
I love that. Now, John, I'm going to leave you to either talk about Trump or talk about NAFTA. Which one would you like to?
Oh, Trump's much more fun.
Yeah.
And although, I will say, and I make no assumptions about the politics of people here, although I know in Canada, I think it's about 80% of Canadians can't stand Trump. People are always asking me on my show, why don't we have a pro-Trump panelist on all of my roundtables? I can't find one.
He's recruiting, so,
yeah,
if you're
sure.
available.
I can say, it's more cultural, my impressions of the whole thing, and it's a spectacle. It's a grand spectacle. Every morning we get up and see what the president's going to tweet. There's a principle called the Overton window, which is what is sort of, if you were doing a Venn diagram, what is within the circle of reasonable discourse? And now with Trump, it's like this. I have to figure out every day, what do I say when the president says asshole, grab her by the pee? Everything is on the table these days. Nothing is presidential, and yet he endures. What's interesting, though, is I agree with Brett. He's enjoying what I think is the Obama bounce. A lot of very, very hard work done since 2008 and mostly since 2009 set the table for the incredible times we're living in. And if he wants to take credit for it, knock yourself out. I really don't care. But I am of the belief that he will not finish his term. I don't know if he's going to be impeached. I don't know if there will be a health issue. I often think that he's going to look at the fact that his personal brand has been ruined. His company no longer makes the money it used to make. It never made as much as he said it did. His family's being savaged. His wife currently is not on a trip with him because, oh yeah, speaking of the Overton circle, he had an affair with a porn star while he was married with a child, and nobody cares anymore. That's how odd a world we're living in right now. I think someday he may just say, screw this, I tried, it's no fun, I don't like it, I'm going home.
Yeah.
Wow. Well, thank you for that perspective. A little different than what I was. That's not what you had in your notes, John, when you said what you were going to say.
Having written a thesis on NAFTA, I think I'm done with it.
And just as an FYI, my daughter goes to University of Edinburgh, and as a result of that, we spent a weekend with 12 of her colleagues from the university, mostly from around Europe, none from Canada, and they all were talking about Trump.
Sure.
So it's not just in North America, in Europe, he's also a subject of our conversation. Yeah. Okay, so as a last chance to wrap it up, so for last question, John, Brett, I'll start with you, Brett. If people were to take home one thought, one idea from you about outlook for 2018, what would you like to go home with?
Well, we've already talked about things being in a pretty good sweet spot. So on top of that, it's a sweet spot where money is getting more expensive. Interest rates will keep going up. If you keep one little nugget about monetary policy in mind, we estimate that potential GDP growth in Canada is around 1.6%. So whenever you see growth rates higher than that, it's pretty much a signal that the Bank of Canada is going to keep raising interest rates. So we expect 2 more rate hikes this year, 3 more in 2019 to take us to 2.5%. You might see the governor say, maybe yes, maybe no. Again, almost look through those statements because the underlying logic of the numbers is so strong. Interest rates are going to keep going up unless we see some huge disaster take place.
2 more this year.
2 more this year.
So that could put prime rate. What could that move prime rate up to? I know they're not exactly correlated.
Well, it moves more or less in lockstep. It's about 2 full points higher than the monetary policy target rate, which is 1.25 right now. Prime's at 3.4. So, think about prime going somewhere close to 5.
Wow. Okay, that's it. I'll remember that one. And John, if you
Yeah.
had one thought for people to take away with them?
Well,
not
I'm not,
this year, by the end
Not,
of
not this, by the end
2019.
of 2019. Thank you
Yeah.
for
I'm
clarifying.
not necessarily in
End
the
of 2019.
advice-giving business. That's why I have a financial manager. But it's more philosophical. I just, I think I guess I'm very lucky. I'm in my early 50s, so I've got 10 to 15 years before I need to cash out. So I'm particularly excited about where things are right now. As a matter of fact, I can ride through this cycle and make some money and then ride through the inevitable recession. But a lot of, the intention of the federal Liberal government and the Bank of Canada in the 90s in formulating a lot of economic policy and ideas and reshaping things was that a rising tide would lift all boats. And it didn't actually happen in the 1990s. And it's one of the great failings of, a finance minister and a prime minister I admire tremendously, Paul Martin. But it just didn't happen. I think it is going to happen this time. I worry very much about a certain cleaving off of the economy, that the very rich and the very poor. But I also see at the level of employment now and with rising wages, and as I said off the top, this fact that I think we have more means of controlling the extremes of if things are moving too fast or not moving slowly or moving too slowly. So I can just say I'm very optimistic for the year to come and for the 5 years to come.
All right, good, thank you, John. All right, let's open it up to questions from the audience. What we're going to do is we're going to have two people walking up and down these aisles with microphones in the outside aisles, and we'd like you to make your way to the microphone, and they're going to hold the microphone for you. So who had, so Richard, you had a question. Michael, could you come down here and get Richard? So Richard, if you just stand up and go, stand beside Michael, and
Actually, I'd like to address some questions to both of you, if I could.
okay.
So first, John, have you done recently a show? I haven't heard, so I'm sorry.
Oh, you're missing great radio.
I'm going to start now.
Okay.
Because you're a
Who's
great
Talk
talker.
1010?
Thank you.
But my question is, have you done a show recently where you've checked in with the listening public as to consumer debt and what the impact is on them and how they feel about things?
Yeah, we touch on it from time to time because you're right. It's a dark shadow that looms out there, and there are people. I forget what the latest figures were of people who said if interest rates went up by 1%, they would fall behind on the house payment. Mm-hmm. But you're right. That is a very, very concerning thing, and you hear a lot of very heartbreaking stories, and you hear stories about double-income families that still can't get by and they can't afford the daycare. So I don't necessarily know what the conclusion to this impression for you would be. But yes, consumer debt is very worrisome. And I think part of that is because debt, money's been so cheap for so long.
So the offset to that was really, so given what Brett said about interest rates, what black swan sort of event does that pick up for you?
Maybe I'm too glass half full. I just always think, in spite of the fact that people say that they are not going to be able to manage, I think sometimes they're being catastrophists. Mm-hmm.
Over-catastrophizing.
Overly
catastrophizing.
I don't see it. I see it as a shadow. I don't see it as a meteor. Let's put it that way.
Good answer, thank you.
Yeah, and I mean, I'd like to build on that.
On my metaphor?
Yeah, well, actually, all of it. Like, in that, actually, what I want to build on is your notion of economic porn, in fact. The stories about, the two-income households who, with, 50 more basis points in rates aren't going to be able to make ends meet, are going to keep coming out. And they make great copy, in Maclean's or in the Financial Post or whatever. But the aggregate data don't actually point to there being a lot of those folks. The hedge funds in New York that are taking bets against Canada like to cite the ratio of debt to personal disposable income. And they'll cite that ratio, which is around 160% in Canada, is at almost exactly the same level it was at in the United States before the financial crisis broke out. Mm-hmm. And they'll say, well, see, Canada's about to go the same way as the United States. But in fact, household debt is a really different looking animal here. When you look at what that debt is deployed to, we have much higher real estate componentry in the asset side of our balance sheets. And our equity value in that real estate is way higher than it's ever been in the United States in the last 25 years or so, in part because we've always had much tighter mortgage rules than in the U.S. So,
Well, our mortgages are not a fraud as they were in 2006,
Right.
2007. Yeah.
well, there's that, and we also have full recourse mortgages, so you can't just walk away
Right.
from a mortgage in Canada the way you can in the States and say, yeah, there are the keys, take it, I'm done. I mean, you're stuck with that mortgage whether you want to keep paying on it or not. And that has meant probably more prudent lending and also more prudent borrowing decisions too. If you look at mortgages themselves, the 5-year reset on mortgage rates is by far the most popular in Canada. And even with the recent 3 rate increases, if you assume that there was pretty much a constant flow of mortgage underwriting over the last 5 years, people who took out a mortgage in 2013 are refinancing now at almost exactly the same rate they've already got. They aren't seeing an increase. People who financed around 2015, sure, when we hit 2020, it's likely they're going to have higher rates, but not substantially higher. And incomes are growing at a rate that will probably allow them to stay pretty much, again, in the aggregate, more or less caught up to that increase in rates. So again, it's really hard to generate the disaster scenario that's going to allow me to buy a place in Cabbagetown. And that's the metric I keep coming back to. And Baby is not getting a house off Parliament, unfortunately.
Now, to be fair to everyone in the audience here, no, we've probably taken way longer than we were supposed to. Don't feel shy if you need to get up and leave. I'd like to, if it's okay with everyone, I'd like to open it up for a few more questions because we don't often get 2 such distinguished speakers. So is that all right if we keep going, but no one feel the least bit shy about if you have to get up and go? Was there another question? Rhonda, anyone up? Yeah. So.
Hello. I was very reassured that I wound up my investments in, was it Equatorial Guinea?
Equatorial Guinea.
As well as North Korea.
Man, those were great trades. You're far better timing this than I am.
Okay, so those are the 4 worst countries. Now, I'm not that familiar with stuff outside of Canada and the U.S. What are the 4 best countries?
Well, in the G7, Canada is the fastest growing country right now. So you're sitting in one of the best countries. Outside of the G7, I think what is really interesting right now is the pickup in emerging markets. Because in 2015, you had a real downturn in commodity prices. Most emerging markets are pretty heavily dependent upon the production of natural resources in some form or another. So with that synchronized global growth happening, and that synchronization is including China, which is looking like it's going to pick up its growth rate a little bit. You're seeing a big increase in demand for oil, for base metals, for lumber and other softs, and that's going to be strongly beneficial for emerging markets. You're also seeing a pickup in Europe. I mean, again, a lot of years of hard work on policy reform, on structural reform in the balance sheets of the lending system in these economies, really changing the way the whole European Union works to make it more robust. All that work is finally bearing fruit. And actually, I should just put a little asterisk on that finally, because we like to kind of fall back on this rhetorical pose that the recovery from 2008 has been incredibly long, policymakers have screwed it up, like nothing has gone right. If you look at the historical sweep of financial crises like the one we had in 2008, 8 years is the average for recovery. So we are right on the mean for how long it takes to recover from something as catastrophic as 2008 was.
Right.
And the fruit from that recovery, I think, is really ripening in emerging markets and in Europe.
Yeah, and there's you can buy emerging markets separately as an asset class, or international investments do include some component of emerging markets, and the manager of that international investment could decide to own a little bit more or a little bit less. Do we have another question for the?
Thanks. John, just want to say I really like your show. I love listening to you in the morning.
Thank you very much.
But a question for you. With respect to North Korea, how worried should we be about North Korea. And what I mean by worried is like firing a missile and triggering a war. I guess, what is the probability of that happening, and what's the worst case scenario? Like, how worried should we be?
Oh, is that for me? Oh, I'm sorry.
You got all the compliments about your show. My publications
No,
didn't get
I
any.
thought it was
any
sort of like,
criticism.
you compliment the person you're not going to ask to dance.
That didn't let you off the hook.
Again, glass half full of nuclear bomb, but I just think that we live in an era, and this era reaches back to the end of the Second World War, where it's very unlikely we're going to end up in a situation like that. I mean, as much as you want to say that Kim Jong-un is a provocative lunatic, he wants something, which is why he's developed the bomb. And as much as Donald Trump may be unstable, I don't think he's just going to wake up one night and stumble down to the Oval Office and ask the guys to turn the keys. I think there'll be a peaceful outcome. I don't know what it will be, but it'll probably amount to the United States having to bribe North Korea to a certain degree. And then, of course, Donald Trump will have to find a way to say he didn't do it. The other scenario, without getting into too much geopolitics, the other scenario is, and we've seen it already, that South Korea no longer feels like the United States really has its back, so it starts cozying up to China and North Korea, and then we end up with an isolationist situation, which won't be that isolationist, but I don't see us going to war. So you don't have to invest in bomb shelters.
Right.
Another question? Roger?
The previous question was about Europe, and we got a pretty rosy picture on Europe. What impact is Brexit going to have?
On Europe, I don't think it's going to have much impact at all. On the UK, it's going to have a major impact.
Already.
It's already having big impact. You're seeing inflation at 3%. You're seeing, even though growth has weakened, the Bank of England has to hike rates in a situation where it'd really much rather be cutting rates. You've seen investment decisions by major multinationals get put on hold. In the UK, every large financial corporation like Bank of Nova Scotia started looking at moving staff out of the city in London. And the financial sector is 10% of the British economy. So none of that bodes well for the UK. That said, the UK is probably the most robust society and culture in Europe. It is the one European country that is actually able to absorb immigrants really successfully. And is probably the closest thing Europe has to a multicultural society like the immigrant society we have here. So, over the longer term, I'm not of the camp that thinks this is the beginning of a long, interminable decline, but it's certainly the beginning of a few years of a lot of upset where things are not going to go smoothly.
Yeah, there is thought that there's a housing bubble in the UK and London, much as we talk about here, and what could happen if that housing bubble in the UK were to burst as a result of the things going on around Brexit.
Yeah, because a lot of that investment in London is contingent on international investment. So to the extent that the UK is digging,
Well, and people
its
leaving.
attractiveness,
Yeah.
fewer people coming and more people leaving. None of that's good for the market there.
You had a question?
I was just wondering, oh, by the way, we have a couple of places in Cabbage Town.
Oh, awesome.
Oh, did you want to go? No, go ahead. Oh. No, go ahead. Yeah, Amy and I thank you, Darren. Another great event. We're always fascinated by, what is the effect on stocks? Where will it affect the economy and even the local real estate market? The power sustainability of the China engine that we think is, still very much driving the world economy. Is it still pushing forward? Is it viable for another year, 2 years or more?
Chinese growth?
Yes.
Yeah.
And then what effect is it having on the stocks and the real estate market?
Yeah, there have been a lot of really gutsy, smart people who've tried to bet against China over the last 6 or 7 years and had their hat handed to them. I think they forget that the Chinese authorities still have very strong levers of control on the Chinese economy. They can pump credit into the financial system incredibly quickly and withdraw it as well. And you've also actually seen the beginning of the transformation that any China watcher has said needs to happen to make it a durable, growing economy over the longer term, which is to switch from an export-oriented economy where it relies on very cheap labor, building everything for the world and sending it abroad, which is engendering some of that protectionist response from people like Trump, to one where Chinese growing middle class actually starts consuming, their output themselves. And you've seen actually a really substantial move on that front over the last decade or so that hasn't actually gone as remarked as it should be. China is moving to what would be a more sustainable growth model, and I expect to see that continue.
We'll take 2 more questions. Joe?
This question is for John. Every year when we meet with Darren, we talk about outside politics, what will happen with Trump or other things in Europe. I'd like your opinion on what your talkers are talking to you about Kathleen Wynne with the minimum wage.
Yeah.
For example, we've had a bit of a bombshell this evening, and what your outlook might be for a provincial election upcoming.
Sure. Well, we have 2 elections this year, and not everybody here lives in Toronto, but we have the municipal election. I think John Tory will be elected. I think it's going to be a messy campaign. I don't think mayors change economic outcomes too much on, on portfolios, but I'm very pleased that John Tory is the mayor, and I believe he'll be reelected. But Kathleen Wynne is a tough call, and certainly everything changed last night at 9:45. I go to bed early. I have the social life of an 8-year-old because I start my workday at 2:45. So I was asleep at 9 o'clock when my cell phone started to vibrate, and somebody just said, turn on the damn television. And of course, Patrick Brown is out. I don't know who's going to take over, but there's, this is like economics, but with more guesswork. Anything could happen in June. I don't think any of it's bad. I think that Kathleen Wynne stands a very good chance of being reelected. I heard an audible groan.
I heard that too.
Because she's familiar, because the economy is doing well. It's a much more liberal government than suits my purposes and interests and tax dollars, but a lot of things have kind of paid off for this government because they're riding the wave at the right time. The economy's growing. I honestly believe, and you might weigh in on this, where it comes to the minimum wage, first of all, in my background in economics, it's mixed result, but the people, again, to use the word, who predict catastrophe are fibbing. It does not happen. You have short-term adjustment and then things begin to rise. I actually think almost like a wave coming in and a lady lifting her skirt at just the right time. I think this minimum wage hike, maybe that's a really stupid metaphor.
You're the one that tipped us into porn, John. I mean, I don't know.
I honestly believe that it's a sizable increase, but it's going to match the overall growth in the economy such that the tumult is not going to be that much. I don't believe there's going to be all that much of an adjustment, and I think there's going to be some inflation, but I think overall the rising tide is going to lift all boats, and apparently skirts. What's interesting is this: who will head the Conservative Party into the election, and can they beat Kathleen Wynne? There was I didn't think there was any way Patrick Brown could beat Kathleen Wynne. He's a cipher, he's an oddball, and now we know how much of an oddball he is. But Vic Fedeli is a friend of mine. He said he's running. I think Vic Fedeli would be an amazing premier, and I would be certainly proud to have him as premier. Maybe the defeated candidate from the last round, Christine Elliott, comes back. Again, solid, could pull it off. Are they going to risk it? Somebody in the caucus this morning said, the problem with this party is we go with somebody who has experience but no brains, or brains and no experience. So, would they go with Carolyn Mulrooney, who has no experience? She's not even a sitting MPP. Am I worried? No, not at all. I think the province is in fairly sound hands. I think our economy our finances are moving towards some semblance of balance. So I don't know if you were scared by how things were going. I know you're scared by the prospect of another 4 years of Kathleen Wynne.
Brett, could you wade in just quickly on minimum wage?
Yeah. On minimum wage, I think something to reflect on. I think there's a reasonable conversation to have about, has it moved up too quickly? Was it presaged with enough preparation and announcement? What is really difficult to argue with, though, is the need to put more money in the pockets of low-income households in Ontario. So whether you do it through a minimum wage or you do it through something like an earned income tax credit, which a lot of economists kind of prefer, I'm a little agnostic on, but one thing to keep in mind, when you discount Ontario's minimum wage for inflation, it didn't rise in real terms in any substantial way for the last 35 years. It was flat. And if you look at what's happened to households that rely on wages alone for their income since the financial crisis, their wages have been flat. And if, by contrast, as everyone in this room is, you own property, you own a house, you own equity in stocks, or you own equity in a small business, you've done phenomenally well by comparison. And to me, the discussion about the minimum wage has to be as much about economic stability as social and political stability. To me, the reason why we got Trump in the United States is because poor and lower income people felt like even though they could probably see he wasn't in their interest, they were so committed to the idea of poking the eye of what they perceived as the elite to say, hey, listen to us for a change. We're getting screwed. If we want to prevent that happening here, and I think most of us do, something like a minimum wage increase is exactly the kind of thing we need to put into place. Now, I know I'm the only bank economist saying that right now, but I am really comfortable with being an outlier on that front.
Well, that's a great analysis. Thank you, Brett, because I hadn't heard that opinion from one of the bank economists, most certainly. Thank you for that. A last question before people want to go?
My question has to do, actually it ties in very well with the last statement, is as more people are becoming retired, there's obviously a mismatch between the skills that are coming into the marketplace and the ones that are exiting. Yes, there's also there's tumult in how we're doing things, but this mismatch is resulting in many cases, internships. I know internships that have gone on for 3 years, which under the old rules, you bring a person on, they do okay, you hire them full time. This way they're just all contractual labor. It's the gig economy. That too contributes to, poke your eye out type in the long term. When we look at it economically, what are the nudges that we can put into place to alleviate what will impact us 3 years, 4 years down the line?
I think for retired folk especially, or for the economy as a whole? Well, I think, one of the things, that I think we're getting right in Canada now is, and again, I'm going to put myself in an outlier position, I think, a lot like the bomb, we need to learn to love the deficit because interest rates are still near historic lows. We have major infrastructure and other productivity enhancing investments we need to make in Canada that aren't happening in a big way from private sector investment. So there's a real space for government investment to continue to put some of those pillars in place we need to ensure that productivity keeps growing, even though we're getting a shrinking number of people working to support the number of people retired in this country. So that stretches from things like building a dedicated passenger rail line between Ottawa, Toronto, and Montreal. Think of how much savings would come in terms of time, money, and frustration if the existing VIA technology, don't even think about high-speed rail, but trains actually didn't have to wait for freight when they're going on those corridors. There are a ton of things like that we need to do. There are things like investing in people too, but we're already doing a pretty good job of that, actually. Canada has almost the highest, I think the highest rate of post-secondary graduation in the developed world. And so maybe there's some tweaking we need to do around what people are studying, but we're doing a pretty successful job of getting people into school and keeping them there. So yeah, I think those are the things to look at.
Thanks, Brett. And the idea of infrastructure spend is one that's important both, throughout North America. And infrastructure is something that in the past kind of only pension funds did. But in today's world, as an investor, you can actually buy infrastructure. And it's something you should maybe think about in a diversified. You talked about some alternative type investments, and infrastructure can provide some alternative to the traditional asset allocation. So on that, I'd like to say thank you very much. Brett, appreciate your time.
Great to talk with you.
Thank you very much, John. I don't know if you guys are going to hang around a little bit in the front or if you have to go, but we'll be out there. And thank you all for being here tonight. It was a great pleasure and really enjoyed it. I hope everyone else did too.
Thank you.
With you, I'm afraid I'd